Imagine this. You're sitting at a coffee shop sipping your latte and you overhear two people talking. One says, "I'll never be rich. I don't have thousands to invest." The other smiles and replies, "Funny thing is, I only put $100 a week into a few ETFs. And by the time I retire, I'll have over $1 million. Sounds unbelievable, right? But it's not. In fact, the math checks out. Here's the truth. Most people overestimate what it takes to build wealth. They think you need a huge inheritance, insider knowledge, or a Wall Street salary. But the secret weapon isn't timing the market or picking the next Tesla. It's something much simpler: consistency. Just $100 a week, the cost of one dinner out, can change your entire financial future if you put it into the right places. In this video, we're breaking down exactly how that works. I'll show you how investing $100 per week into just 3 powerful ETFs can turn into a retirement nest egg worth over $1 million. You'll see the real numbers, the compounding math, and why these 3 ETFs are smart picks for long-term investors. Now, before I show you the exact ETFs that can take $100 a week and turn it into $1 million retirement portfolio, let's talk about how we're going to split that money. Because the way you divide your contributions matters just as much as what you invest in. We're going to follow something called the 50-30-20 rule. Now, if you've ever tried to stick to a budget, you've probably heard of the 50-30-20 rule. It's one of the simplest ways people organize their money. The idea is that you split your income into 3 buckets. Half of it goes toward your needs, 30% covers your wants, and the last 20% gets saved or invested. It's not complicated, and that's the point. It gives you balance. You're not spending everything, but you're not depriving yourself either. Now, what's powerful about this rule is how easy it is to picture. Imagine you get a $1,000 paycheck. $500 goes to rent, food, and bills. $300 might cover dinners out, movie nights, or a weekend trip. The last $200 gets tucked away into savings or investments. You don't need an MBA to understand it. It's money management in plain English. And here's the twist. That same 50-30-20 principle can be flipped around and applied directly to investing. Instead of thinking about rent or vacations, we'll think about stability, growth, and income. By dividing your $100 a week into those 3 categories, you'll not only invest consistently, you'll also build a portfolio that's balanced, diversified, and designed to grow over decades. So let's start with the foundation, because every strong portfolio needs one. This is where VTI, the Vanguard Total Stock Market ETF, comes in. Think of it as buying a tiny piece of nearly the entire US economy. With just one investment, you're holding more than 3,500 companies, everything from Apple, Microsoft, and Amazon, all the way down to small startups you've probably never heard of. It's diversification in a single move. And the best part? VTI is incredibly cheap to own. The expense ratio is just 0.03%. That means if you invest $10,000, you're paying about $3 a year in fees. The rest of your money stays in the market, working for you. Over the past decade, VTI has averaged an annual return of roughly 14%. Even if we zoom out longer, the 10% historical average for the total US stock market has held strong decade after decade. Now let's break it down with our $100 per week plan. Since we're using the 50-30-20 split, half of that goes into VTI. That's $50 every week, or $2,600 a year. After just 1 year, your $2,600 investment grows to about $2,730 at a 10% return. Not life-changing yet, but it's the start of a snowball. Fast forward to 10 years, you've contributed $26,000, but with compounding, it's worth about $43,000. That's $17,000 you didn't have to earn. Your money did the work. Go out to 20 years, and those steady $50 deposits add up to $52,000 in contributions. But compounding takes over, turning it into roughly $153,000. Double that timeline to 30 years, and your $78,000 in contributions grows into about $362,000. That's nearly 5 times the amount you actually put in. And here's something people forget. VTI also pays dividends. The yield is modest, around 1.1% a year, but over time, those dividends become real income. After 10 years, your balance could pay you about $40 a month. After 20 years, closer to $140 a month. And by year 30, you're looking at more than $300 a month. Basically, a utility bill covered by your investments every single month without you lifting a finger. Now that we've built the foundation, let's add some fuel to the fire. This is where VGT, the Vanguard Information Technology ETF, comes in. If VTI is the entire US economy, VGT is the beating heart of innovation, technology. When you invest in VGT, you're not just buying stocks, you're buying into the companies that shape the way we live every single day. Its top holdings include names you know: Apple, Microsoft, Nvidia, Broadcom, Oracle. These aren't just businesses. They're the engines driving cloud computing, artificial intelligence, semiconductors, and software. Every time you unlock your phone, stream a movie, or swipe your credit card, there's a good chance one of these companies is behind it. The numbers back up the hype. VGT has an expense ratio of 0.09%, still dirt cheap for what it gives you. But the real story is performance. Over the past 10 years, VGT has averaged an annual return of more than 20%. Even in the past year alone, it's posted gains north of 22%. That's double the return of the broader market, but of course, it comes with higher volatility. Tech stocks can swing big, both up and down. So what does this mean with our $100 a week plan? Remember, 30% of our weekly investment goes here. That's $30 a week, or $1,560 a year. After the first year, your contributions plus growth are worth about $1,690 at a 20% return. It's not a huge jump yet, but wait until compounding takes over. After 10 years, you've put in $15,600, but the balance grows to around $48,600. That's 3 times your contributions in just a decade. Stretch it to 20 years. Your total contributions are $31,200, but at that same 20% annual growth rate, you're looking at more than $151,000. And by 30 years, your steady $30 per week habit adds up to $46,800 out of pocket. But your balance explodes to nearly $467,000. That's the magic of growth. It multiplies your efforts tenfold. Now let's talk income. VGT isn't known for dividends. The yield is tiny, less than 0.5%. But that's not why you own it. This fund is all about growth. We've covered the broad market with VTI, and we've added growth with VGT. Now, let's bring in the piece that adds stability and income. VNQ, the Vanguard Real Estate ETF. When you buy VNQ, you're not buying houses or apartments directly. You're investing in companies called REITs, Real Estate Investment Trusts. These are businesses that own and operate real estate across the country. Shopping malls, office buildings, apartment complexes, healthcare centres, even the telecom towers that keep your phone connected. And here's the best part. By law, REITs have to pay out at least 90% of their taxable income to shareholders as dividends. That means VNQ is built for steady cash flow. The numbers show why it earns a place in this strategy. VNQ has an expense ratio of 0.13%, which is still low compared to most real estate funds. Its dividend yield is much higher than VTI or VGT, sitting around 3.8% today. Over the last decade, the fund has returned an average of about 5 to 6% annually. Not as flashy as tech, but reliable. And that reliability becomes very powerful when you're thinking about income in retirement. So how does it look with our $100 a week plan? 20% of that money goes into VNQ, which means $20 a week, or $1,040 a year. After just 1 year, your investment grows to about $1,095 at a 5% return. After 10 years, you've contributed $10,400, and with compounding, it grows to roughly $13,800. At 20 years, your $20,800 in contributions becomes about $36,600. And after 30 years, your total contributions of $31,200 grow to nearly $84,000. $100,000. But here's where VNQ really shines. The dividends. Even after just 10 years, your balance could pay you around $40 a month in income. After 20 years, that climbs to about $115 a month. And by year 30, you're looking at over $260 a month in dividend income alone. That's like your internet, your phone bill, or even a chunk of your rent covered every single month forever. And remember, that's without selling a single share. Now we have the full picture. Let's see what happens when you put it all together. Over 30 years, you've invested a total of $156,000, just $100 a week, every week, for 3 decades. But thanks to compounding, that steady contribution grows far beyond what you put in. Put it all together, and your total portfolio comes out to more than $900,000. And that's using conservative averages. And that's the real power of this 50-30-20 plan. It doesn't just aim to make you a millionaire. It builds a portfolio designed to support you throughout your life.